We live in a VUCA world, and this is a term that I learned recently. But VUCA is volatile, uncertain, complicated, and ambiguous.
I agree to your point that there is volatility outside India. But we are fortunate that India is the least volatile market in the world at the moment. I only focus about risk, managing risk, because I believe like if you control the risk, then return is a byproduct. Unfortunately, investors chase returns and then they lose their corpus. Any financial plan is like building a house, and children's objectives are the pillar and retirement is the roof,
Yeah.
and the foundation is protection. I feel in the last 1 year, the risk of equity is now transferred to gold. Avoid taking loan in India. India is not a friendly country to borrow. I don't consider this as an investment. I'm sorry, I'm very brutal. If you get educated outside in India, then you are pushed to take a job outside India. Otherwise, the break even doesn't occur here in India.
Hi, hello, welcome back to InnoTalks. Today seems like a day to talk about finance. Last time we spoke about finance, it was for Artha Manthan, episode number 1. That episode we shot in Marathi, and we spoke about how small and medium business entrepreneurs should actually run their business financially. Today at the InnoTalk studio, we have Mr. Ram Subramanian with us. Ram has an illustrious experience in managing people's money. When we were researching for this podcast, he told me that he manages about 250 to 300 crores of retail investors' money every month. That number itself was a big thing to think about getting Ram into the InnoTalk studio. There's a reason for that. We live in a VUCA world, and this is a term that I learned recently, but VUCA is volatile, uncertain, complicated, and ambiguous. And in a VUCA world, which is being taken over by AI, where every startup is talking about AI, but we have a very young population in India, how should they conduct and manage their finances is the question. In a VUCA world, whatever the young couples want to really achieve could be delayed just because maybe they do not know what to do with their finances and how to handle them. Maybe somebody wants to have a kid, but they may not know how much finances will be required to take care of that kid from conception to about adulthood. Maybe somebody has parents who are aging way past 90 because longevity is increasing, but they're worried about how the insurance is going to work out and so many other things around health as well. Typically, each one of us, we are looking to have good health, make good careers, have great relationships, and also have enough money to retire with. And these are the questions we are here to talk about with Mr. Ram at the InnoTalk studio. Watch this episode till the end and do give your comments on what you liked about this and what resonated with you. Ram, welcome to InnoTalks.
Pleasure's mine.
Ram, like I said, this is a VUCA world. Everything is uncertain. I mean, AI is taking over. Just last week, I heard about one of the big companies doing almost 30,000 layoffs. It was not in India, luckily. Geopolitically, also, there are wars that are happening everywhere around. The American president has his own ways of dealing with the world. And India has a young population. So we have what Nandan Nilikeni had actually coined as a demographic dividend, which we may or may not be able to use, but that's a different problem. But the young India has aspirations, and the aspirations are of building great wealth so that they can, satisfy all their desires, have kids, care about their parents, and also retire rich, hopefully. What, according to you, how can this young India secure their life financially in such an uncertain world?
Okay. I agree to your point that there is volatility outside India. But we are fortunate that India is the least volatile market in the world at the moment. There are various risk parameters we can analyze, and the extent of volatility is very, very less as compared to what you will be withstanding outside India. So, volatility is an opportunity, provided you give important medicine of time. So, like one should plan, and one should plan effectively, budget, plan, and then have a proper strategy in place. And so, this can be met with if a person is smart enough to preserve his health. And if he can generate income, and if he's indispensable in his profession, and if we can have a long-term runway visibility, everything can be achieved. Yes, like for example, the journey will not be linear, but the journey will be tumultuous. But then, like if the planning is good, then everything is doable. Yeah.
If you look at age groups and try to look at 2 or 3 different age groups where somebody who is starting in a career uh, at 21 and somebody who is way past 40 or 45, uh, but both of these people have not saved enough. So the one who is at 40, 45 years of age, maybe they have not saved because they had some other goals, and the one who is at 21, they don't have the money as yet because they are just starting out, and which is why they have not thought of a savings plan. How would you coach both these people personas to manage their money well?
Yeah, definitely. Like if they can, as I said, the extent of risk that 45-year-old guy will be withstanding will be the higher. Like
Yeah.
the 21, the guy who aged 21 is the fortunate guy.
Yeah.
He may be investing a small money, but that small money will compound to a big multiple by the time he retires.
Yeah.
So that is a smart work.
Yeah.
But the age 45 guy will do a hard work.
Yeah.
Like he will have to pump in more, and every day he will have his heart in his mouth. Like, will his profession be rewarding, or
Yeah.
will he be laid off? Wagera. That kind of risk that he will have to withstand.
Yeah.
This thing, but yes, it is doable. Like the age 45 guy will have to shell out more, but the age 21 guy will enjoy the advantage of compounding, and everything is doable.
Do you have clients who have started late in terms of saving their money? Let us say 40 plus people who have come to you and said, Ram, I want to make money. And so 2 questions. What are the typical goals that these people come up with? And let us say if they have a 20-year runway where they have to retire by 60, how do you really guide them in terms of building wealth for their retirement?
Yeah.
Could you give examples from your
Yeah,
client
yeah.
base? Yeah.
So I'll give an example. I know this thing. I have a CFO in my clientele, and he is highly educated, and he takes calls for his organization level, like for example, investment calls, mergers and acquisition, and various calls. But he was a very conservative in terms of his individual finances. He was only into FDs. He was extremely conservative guy. And I gave him an education. Like for example, it is impossible for you to meet up your child's goal and all those, and you will have to work at least, like for example, I acquired him this thing at age 39. He was 39 years of age, and I told him that you will have to continue investing till 60. But then, like for example, he was sold on to this. Like for example, he did a trial. Like for example, he started off with around 1,000 rupee a month, experimentation kind of, and thereafter looking at the confidence, like then he stepped up his investments gradually over a period of time. And in 10 years span, like by the time he aged 49, all his goals were met with. Thankfully, the market rewarded that much during that period. I'm not saying that today, if a person invests at this valuation, he will be able to replicate that. So he was able to meet everything. He made a correction from being extremely conservative to little bit asset allocation and a little bit higher equity exposure. That's what he did, a small tweak, and he was able to achieve all his goals. Like that 11 years, like for example, he was able to meet everything in 49. So that 11 years is a profit that he has earned.
And what was his goal like to achieve in 10 years?
His son wanted to pursue medicine, and that was his one goal. And second thing is retirement, and then properties and various. He's into spirituality. Then settling outside India for spiritual reasons. Those were his objectives, and he's in a very very comfortable position.
So you mean he started at 39 with no savings and no investments in real estate or anything else, but he could manage everything in just a span of 11 years?
11 years.
In,
But he
in
was extremely disciplined. Discipline is a key.
But in such a story, you know, I mean, if you look at some numbers, let us say somebody who is a 40-year-old today and wants to retire in another, or wants to comfortably achieve all goals in 10, 11 years, what is the corpus that they should be thinking at when they are when they have really reached that end of 10-year end of decade?
It's very difficult to answer this question because, like, for example, different people will have different lifestyle.
Yeah.
Like, I have a guy who is very content with even 10,000 rupee a month retired life. Yeah, but and then I have another profile who needs around 5 lakh rupee a month for a lifestyle. So the person who has an aspiration to have 5 lakh rupee a month, like, for example, would obviously it require higher corpus than higher savings.
Yeah.
The guy who wants 10,000 rupee a month in retirement, like, he may save smaller money. So, like, it depends on the aspirations. It's very difficult to give an exact figure.
Yeah.
But it depends on the lifestyle and how do you want to scale up towards your retirement, and the risk. Like, you'll have to think of a lot of risks in the old age also, whether the real rate scenario will be good during your old age, because your old age period will be longer, your earning period will be lesser.
Yeah.
And the interest rate scenario can fall down drastically during the old age.
Right.
So there are a lot of risk. How much risk that a person can tolerate,
Yeah.
you'll have to take call basis this.
Yeah, and then the another thing is that for the 21-year-old who is starting out, he has a big 40-year runway in front of him to actually go ahead and invest his money. But typically, how does your approach change when a 21-year-old comes to you?
Okay, the first thing is, like, for example, I only focus about risk. Managing risk, because I believe, like, if you control the risk, then return is a byproduct. Unfortunately, investors chase returns and then they lose their corpus. So, like, first is when a 21-year-old guy says that I can be gainfully employed till 60 years, then I try to ask this question: would you not face a mid-career correction?
Correct.
So it's like gone are those days. Like, my mother gotten into a government job when she was around 19 years of age, and she retired at 58. So, like, this was possible then.
Yeah.
In today's scenario, you can't think of, like, working for that
So long. Yeah.
basically. So whether you are into business, whether you are into job, mid-career crisis may or may not strike. So what I recommend is, like, for example, yes, these are the good things with which we assume and plan. But yes, like, for example, if there are some hardships in between, then we build enough safety net if our assumptions go wrong. So that's how, like, we plan and we suggest a portfolio to an investor.
Okay. To both these personas, let us say if they want, they come up with a question as to, what kind of emergency fund they should both have. So for a 21-year-old who is just starting out, and for somebody who is 40, let's imagine that he will already have his own kids and, parents to take care of. So how do you estimate what kind of emergency fund each of these personas have?
The possibility of a 21-year-old guy losing job is less, basically. But we do recommend, like, for example, for a 21-year-old guy just starting, 3 months ka emergency corpus. There are no general formulas for this. 3 months of emergency corpus for a 21-year-old
3
guy.
months of the salary.
3 months of the household expense.
Household expense. Okay.
And then, like, for example, for a guy who is around some 30s, a guy with one kid, some 6 months of household expenses plus liabilities and children's expenses and whatever child's educational expenses, because he will also have another 3 months of notice period also.
Correct.
So, like, and the guy who is around 45 years of age, like, he may have, like, for example, far higher outflows and commitments and all those. So, like, something that can address his commitments for around 6 months. So this is what we position this thing. And business class guys emergency fund is altogether different.
How would you tackle that for, let us say, a business that is running well, and then you want to recommend an emergency fund for that business, and how would you
We largely we are very conservative when we are handling business class profiles. So unless they are bullish, extremely bullish, so we don't recommend 100% equity in their portfolio.
Okay.
So we try to build enough the emergency money,
Yeah.
and then we maintain a bucket, emergency bucket, and then like for example, there is a withdrawal going on, and then they replenish this.
Yeah.
And so we segregate their various other goals, business goals, whatever they may have. So then for extremely long term, we will have a very small allocation. The concentration, we play with the concentration, but larger allocation will be towards emergency fund and near term goals for a business class profile.
Yeah. Fair. So that was about emergency funds in itself. Now, in terms of insurance, also, uh, for a business, for somebody who is in business, these days they have products which are also called as the keyman insurance. Would you recommend something like a keyman insurance for somebody who is a 40+ year old and a 20+ year old, or is this keyman insurance the same as what they have as the term insurance product?
See, Keyman is a banner under which a term insurance is given. So I strongly recommend Keyman insurance to both, like any kind of entrepreneur. I recommend Keyman insurance. It will be unwise not to have a Keyman when you run a business,
Okay.
because you would have insured your assets, you would have insured your car, you would have insured your employees.
Yeah.
But the most important person in that organization is that key person.
Yeah.
And it will be unwise if you don't insure that most important person. So then, if the key man, because I believe any business is an empire, and you would have brought it from certain level to certain level. And if the person dies, then, like for example, the nominee may not be that skillful to carry the business in the same way when the director was alive. So then there is a hit to the organization.
Yeah.
So, like for example, if a keyman insurance was there, then his wife may hire a CEO who can do the job in lieu of the deceased person, and CEO will charge a price that keyman sum assured will give that price, and then like the business empire objectives of the organization can be carried forward.
Yeah.
So this is one benefit of keyman. Besides, there are several benefits of keyman. So it will be unwise if you don't have a keyman, and this thing, and the price that you pay for that keyman net of tax is a very small price.
Of course, but that is at an early age if you start investing as early as possible, no? But the insurance premium that you pay net of tax will keep on growing as your age grows. If you delay buying the keyman insurance
No,
to a
no,
later
that
date.
is a minor cost, because, like for example, guy who is around 21 years, like his the replacement value for that organization will be very small. The guy who will be at 45 years, like for example, his contribution to that business and his replacement value will be bigger. So, like for example, as a percentage of the income generation of the organization, if you look at from that ratio point of view,
Yeah.
it will be minuscule.
Yeah, makes sense. So that's a very interesting area about insurance, and these days you have so many insurance people who do not really understand insurance in a very big way. They come to you and they sell you various insurance products that they may have, but for any of these personas, we discuss somebody who is 22, 25 years of age, or 40 to 50 years of age, or even somebody who is in business. What kind of insurance products should each of these personas have, no matter what? Like, is there a list of must-have insurances that all of these should have, or based on whatever you recommend to your clients?
See, the first and foremost thing, like any financial plan, is like building a house, and children's objectives or the pillar, and retirement is the roof,
Yeah.
and the foundation is protection.
Yeah.
The protection may be, like for example, life insurance protection, or a personal accident protection, loss of health insurance protection, or a key man insurance, or a disability protection, or a liability protection, various other things. All this protection, like for example, if a person chooses wisely, plans wisely, and if he interacts with a qualified guy, it can be accommodated. It may not cost much also. So 1% of their possibly their yearly income. It can be accommodated within that 1%. So, like the first and foremost is, like for example, term insurance is needed. If a person doesn't, if he's a breadwinner of the family, if the term insurance is not there, then the family will suffer. The
Yeah.
dependence objectives may not be met with.
True.
So then, like for example, loss of then there are various other factors the person will have to look at. His genetic risk that he has, morbidity, his lifestyle, and his habits, basis which he should choose a good health insurance cover, critical illness cover, and if it travels, if there's a road risk, then he should have a good disability protection and liabilities, like which is picking up very fast in India. So these are the protection one can have.
Yeah. So you talked about term insurance. Then there is health insurance as well.
Hanji, that's otherwise called as mediclaim.
Mediclaim.
Hanji.
Yeah.
Then I talked about critical illness. The objective
Critical
of
illness.
critical illness is to, if you have a genetic risk from your appliance, and or if you have habits, so then they are based on your lifestyle, stress levels, वगैरह. So you should have a good critical illness to compensate your loss of income. So like if the person gets into dreaded disease strikes him,
Yeah.
then he may not be able to generate income at the same pace what he was doing earlier.
Yeah.
So then there is a financial loss to the family. So
Yeah.
that should be covered.
Correct. Great. So the next point that comes into picture is we spoke about emergency fund, we spoke about insurances that anybody should have. The next building block, so to say, becomes that, when it comes to putting in money for investment, there are so many asset classes, and in India we are a very status driven kind of a population where parents would say that to their kids that you should always have an apartment to your name. So then come the real estate loans and so on and so forth. Or we have a fascination for gold, and the gold prices are going off the roof at the moment. And then of course we have equities, FDs, NPS, PPF, and so many different asset classes, with the latest being, let us say, crypto. And each of these personas, the 20 to 25-year-old, 40 plus, or even the business class, will have affinity towards various of these asset classes. How do you decide for people, or how would you coach each of these personas, or in general, as to which asset classes should the money go into?
It's like, for example, I only give the pros and cons of this asset classes, and then I ask the investor whether he has a risk taking ability to go for that asset class.
Okay.
Like I have a guy who is into investment banking in Mumbai, but he is, like for example, extremely conservative.
Okay.
He says, I don't have the risk taking ability to be in equity at all, and he only deals in traditional instruments.
Okay.
So but then I made him aware that, like for example, you will have to earn certain longer number of years to reach your goals. So it depends. The underlying answer to this question is risk. How much a person should ask himself, like what is the best case scenario that I can see, and what is the worst case scenario that I can withstand? Do I have the ability to withstand this much of risk? So if the person if his heart says yes, he can, then you should choose that asset. There is nothing called good or bad. There are merits, pros and cons in each asset that he chooses, but it's advisable always to have a asset allocation. Like it's like having a thali. Like you will have salads, you will have dal, you will have vegetable, everything. So you build a portfolio in such a way where you have a very good asset allocation.
So if we look at 100% of the pie, and let us say we have to do asset allocation for the long term. Actually, this comes in from a video that I was watching the other day, and that person who had gained enough wealth, about 5 crores or 10 crores worth of wealth, he had about 15 to 16% of all his money, spendable money, in gold. But gold at the current rates seems like a riskier investment to, let us say, someone like me. So what would you say? Is it great to have? How much amount of money should anyone invest in gold and, let us say, real estate?
Okay. I feel in the last 1 year, the risk of equity is now transferred to gold.
Okay.
Okay. And people believe that because it has not crashed in the recent situation days. So they believe that gold cannot, they get into a perception gold cannot crash. So if you speak to a housewife, it's very difficult. She will not be able to believe that gold too can crash. So I'm not saying gold will crash. There is a possibility. When you are investing in any asset, like for example, you think that that can go southwards also. Start with that assumption. So like what I encourage is, like for example, family gold, or some extent there is a ratio that I like recommend.
And what is the
So
ideal ratio?
see, like for example, if there a person has 3 girl children, and in their community, if giving gold in the marriages is a important objective, then that ratio can go up. Then, like for example, I know certain community where they don't give gold in their marriages, like
Yeah.
for example.
Yeah.
So then that ratio, it's a call that the profile will have to take.
And that makes a lot of sense. So, for example, if somebody who is a very young guy or a young woman, 20, 21 years of age and getting into the workforce, and if maybe the priority is not to get married very early, or if, with the changing times, gold, I don't know how dear gold is to the younger generation. So then the percentage of money invested in gold could be lesser. But then, just to make money out of that investment, there's also something that I discovered recently, which is called as an exchange traded fund, where you can use that ETF to invest in the stock market, and there are gold ETFs also, just like there are ETFs for the index based ETFs. So then, can somebody, is it a good product in itself? Is it a
Every
should one
product has
invest?
a merit and a demerit.
Okay.
But an investor should take a call whether it fits in his taste and it's aligned towards his objective or not. Basis that, an investor should take a call.
Okay.
But then what I recommend is like a certain percentage. I believe gold is an insurance. Like in case of event going wrong, like COVID kind of situation reoccurs, then like gold can do well. So, like for example, some kind of a hedge as a protection one can think of. But insurance assets will not reward you like an investment asset. Always one should keep in mind. So that ratio is very critical. So, like some small ratio in gold is good. Like even if you don't invest in gold and say you have chosen a diversified asset, and diversified asset may do well. Like let's ignore this last 1 year period. So, like diversified asset will outdo. You will not be left with a bad taste in your mouth. So, like all your objectives will be
A
met.
diversified asset as in?
A diversified asset is like, for example, equity, debt, and various other portfolio, liquid, emergency funds, and all those.
And then we didn't speak about real estate. So should anybody or everybody who is in the workforce have one house to their name?
See, like
What are the benefits or the pros and cons of it?
real estate is a very good asset. In fact, you will be pushed to buy real estates in a city like Mumbai or Delhi, where like the rentals are high. The rental yield is far higher in those cities. Like every person would like to get rid of the rent and rather choose to have a property in these cities. But then in other pockets of India, if you exclude these 2 pockets in India, other pockets, the rental yield is not that great in real estate.
Yeah.
Like if you do that calculation, like how much of the HRA that you pay and enjoy, and if you don't buy a property and say you be in a rented house and enjoy the HRA, and then like for example, but you save for buying a property, then as you go closer to your retirement, if you purchase a property, then like the deal, you will be in a better deal. Like for example, try avoid taking loan in India. India is not a friendly country to borrow. If you are in some developed countries, the interest rates are far lesser. The borrowing cost is lesser. But in India, the borrowing costs are higher. So like so you lose out on compounding also. So that's why like but then it's a emotional call. Roti kapda makan is always our
Emotional.
philosophy. It's an emotional call. When you invest, like keep your emotions out of your investment, and but then depending on the situation, then you take a call. Like it's always advisable, as long as you can postpone real estate, try to postpone it for the longer period of time.
That's a very interesting take, where you said that borrowing in India is expensive, and you end up paying a lot more for the loan that you have. I think you end up paying almost twice the
Yes.
amount you have borrowed.
Yes.
So then there's an obvious question that comes to my mind is, should anybody who has bought a house already use a portion of their earnings to actually pay that loan off quickly?
I do encourage investors to foreclose their
Loans.
loans at the earliest. So the cash flows, I will divert some amount of their earning towards foreclosing the home loan. And so usually 5 to 7 years is the time period that I keep in mind to make sure that salaried employees foreclose their home loans.
There's another trend in India related to real estate, where when it comes to planning the children's future. So I know of people uh, who have invested in apartments for their children. So let us say if they have two children, then they have invested into one apartment each for each of their children, which they plan to liquidate at a later date when the children really want to go in uh, for education abroad, or pursue higher studies. How good is that as a strategy in 2025 and beyond?
See, there are quite a few demerits that I can foresee. It's a risky decision, first of all. The risk may be by the time, like, for example, the child reaches that milestone age, the real estate in that pocket could crash. The real estate prices could crash. And the second demerit is, like, for example, real estate is not divisible. When I use the word divisible, like if you have 1 crore worth of financial saving, your requirement may be 20 lakhs. You can withdraw 20 lakhs partially from that financial saving.
From the financial
But in
savings.
real estate, if property is worth 1 crore and if you want to withdraw 20 lakhs, you can't sell one bedroom. So
Yeah.
the entire property will have to be sold.
Yeah.
So, and the third thing is it can also become illiquid because of market risk and various other challenges. And fourth thing is like if you factor in the capital gain tax and the cost of money borrowing that you have incurred and the maintenance expenses, the property taxes that you would have paid, then on the stamp duty registration expenses for both on the purchase and also during the registrations, rental registrations, and the income tax that you pay on the rents that you receive, all those if you calculate, then I don't think it can give a significantly higher real rate. Like real rate is net of expenses, net of real rate is net of inflation.
Yeah.
So like I don't think it can give a good real rate. Yes, some pockets like Mumbai, Vagara, it can give a good real rate, but not all in other pockets. So that's why, like for example, the amount of risk is far higher in real estates than like financial savings.
But I think if one could argue it the other way, where let us say in metropolitan cities, let's talk about Pune, where we are, and in areas where the government has a mandate that they want to increase density of population around the metro line. So all the properties that are around the metro line are appreciating faster than probably the ones which are in remote areas, or or far further away from the metro line. So with a minimum investment, even if somebody wants to buy an apartment, would it be a good decision to invest into smaller apartments just as an investment, whereas they are living somewhere else, so that it at least appreciates, and such assets which are closer to the metro lines will always be liquid?
Okay. I don't consider this as an investment. I'm sorry, I'm very brutal. The point is calculated from the rental yield in a non-metropolitan city. How much can be sub 2%? Net of all the expenses, if you calculate, it will be around, and net of all the expenses and taxes, upkeep, maintenance, and all those refurbishing cost once in frequent
Yeah.
intervals. If you factor in all those, like the rental yield may be 2%, less than 2%. So even if you buy it in a metro, this thing. And second thing is like yes, yeah, there is there is a curve. Like for example, at some point in time when there is an announcement of a new project or something, the real estate prices can go up,
Go up.
and then it can also plateau over this thing, and it may frustrate you for a longer span of time in
Yeah.
a plateau phase. So, and the real, like for example, if it becomes a hot pocket like Nariman Point or Worli, then like for example, after hitting a plateau for spending a time for 30 years, then it can move northwards. But that journey will be enjoyed by your next generation and not you.
True.
So that's why like I don't consider it as an investment. So you should have a place to stay. So like if say you are in a 1 BHK and you are feeling the need for 3 BHK, then sell your 1 BHK and then move into a 3 BHK. Do not look at real
If you
estate.
want to buy.
Anji. So for the want of space, you upgrade. But then otherwise, I don't think it as an friendly, usable investment.
Yeah.
Real estate.
So it's better to rent real estate and put that money in equity where it grows. But that's also another, talking about equity. So post COVID, for almost 2, 3, 4 years, there was a bull run, and people were making money of any product, be it a mutual fund, be it investing in direct stocks, or even something else. But are those rates coming down now? Because in one of our conversations, you also mentioned figures like, those rates might go down to as low as 10-12% or even lower. So is equity still attractive, or is there a new asset class that we all need to look at?
Equity is certainly attractive, but the mistake investors do is they measure the performance in terms of absolute numbers. Like, for example, if that asset class gives 18% returns, compounding annual, then they rate it as a good instrument. And if it gives a single digit return at 9%, 10%, then they
It
may
looks very
consider
low.
it very low.
Yeah.
But then measure it with the real rate, like net of inflation and all those. Like, if the market has returned 18%, the inflation would have been 11%. So the real rate would have been 7%.
Correct.
Now, even today, the current inflation is around 1.72%, sub 2%. So even if the equity gives you 9% return, the real rate is 7%. So evaluate the portfolio return basis the real rate. But the drawback that you may see is, like, if that instrument is going to reward you around 9%, possibly over a 10-year span, then, like, what the amount of corpus that you will have to invest may go up, or like the tenure that you will have to stay invested will have to be longer. So yes, but then, like, for example, there is enough juice in the market. We have a fantastic long runway visibility in India.
In India, it still seems a very attractive destination from stock market perspective.
Yes.
Okay, so there's one more question which comes in here. How much is so whenever we meet in friendly circles, the question which seems to have no answer so far as in groups that I have been is, how much money do you truly require to retire? Net of inflation or without inflation or whatever, based on your lifestyle expenses that you wish to have and so on and so forth. But is there a magic formula which people can use when they, are planning for their retirement expenses?
See, broadly, what they can do is, like, what is their lifestyle and today, and they can scale it up. They can do this calculation. How much will it be by the time they retire?
Yeah.
So a person, like, I know a doctor in Pimpri area. He was very confident when I met him for the first time. He said, I will practice till 80 years of age.
Okay.
And he was a very conservative guy, and he did retire at age 80, and very, very conservative, debt instruments only, no equity, and then, like, he built a significant corpus over a period of time. So for that long horizon, so it depends on your lifestyle, your risk taking ability during that accumulation phase. There is a risk even in the annuity phase also. The rates can plummet, and you need to make sure that if the rates are not friendly, like Japan kind of a situation where the rates are very unfriendly during your retirement age, then you should have the liquidity to port that asset class to some other this thing. That's why it's necessary to have a proper planning. Then you need to review very frequently whatever assumptions with which we have started it. Is it traveling in the right direction?
But still, is there a way we can estimate? Let us say that there's somebody who is making 10 lakh rupees a year, and 10 lakh rupees a year, and that person wants to retire as early as possible, and he's calculating a number. So somewhere I read in one of the magazines or wherever that if you multiply the amount that you're making per year today, if you multiply it by a factor of 30 or 25, or let us say 25 or 30, then that is the corpus that you will require to retire. So I think 10 lakhs, that corpus becomes around 3 crores as of today.
No, see, if you are generating 10 lakh rupee a year, not necessarily you.
So is that a good goal to have to?
This is a very crude way of calculating, I believe.
Yeah.
Like, say, if you are generating 10 lakh a year, Possibly like you will spend 4 lakh a year. Out of that, say rest of the money may go for your commitments or for children's expenses, which may not be there by the time you retire. So what percentage of your income generation is something that you will be incurring today and potentially in future? So basis that, like for example, you assume the inflation and then you scale it up and then discount those kind of cash flows and until the life expectancy that you believe you will be able to live. So I assume usually 90 years of age, a very high life expectancy.
Yeah.
And and I assume a very conservative real rate in the retirement calculation. And then I try build a corpus that is required. Then basis that, I encourage our investors to save.
But at least a bare minimum corpus, if anybody has to plan a multiple, then 25, 30, even though it's crude, does it hold?
See,
Like something is better than
see,
nothing
if
strategy. No?
somebody earns around your lifestyle is around 10,000 rupee a month, if he is content with the lifestyle of spending 10,000 rupee a month, possibly this may be good. Somebody like his lifestyle is around 5 lakh rupee a month, then this may be inadequate.
Yeah,
That person may require around 18 crore, 22 crore, something.
That's true. So I think it is all about defining what your habits are going to be,
Anji.
and practically imagining that you're going to live a long life.
There are some calls that my customers have even taken basis their genetic risk. Like one gentleman took a call that my grandmother passed away at this age, my father passed away at this age. I'm not confident. I am diabetic. I am not confident that I'll be living up to 90. Possibly I may even die by age 75. So his life expectancy is lesser.
Yeah.
So then, like for example, his corpus requirement may be lesser also. The various other assumptions in this retirement calculations in this. So we can't put a crude figure that this is adequate. Say for example, if somebody saves only 3 crores and he or his partner lives up to 90 years of age or 95 years of age, then that may be, and the rates plummet to around 0.5% real rate in the old age.
Yeah.
So then he may not be able to sustain.
When you say 0.5% in the real rate in the old age, what does that mean?
That means net of inflation, how much are you able to generate in the old age? Like like for example, if the interest rates go down to around say 1% scenario, and inflation is around 0.5% in the pensionable age, then the real rate is 0.5.
0.5%. Yeah, that makes sense. So we discussed retirement, but somewhere along the way, couples are going to have kids, and typically what I've observed is that whenever one has kids, then the entire financial planning either adds up if you have started saving early, or then it goes for a toss, because it coincides along with the same time when you want to have kids, but your parents are also aging. You also want to, if you're in a job market, you want to try and run your own businesses, and so on and so forth. So with kids in the picture, how does planning for your finances change?
The interesting demand from clients who have kids is, I want to plan for my child's educational goals and milestone goals first. That is the first requirement that comes from my clients. But then I'm of a different opinion. That's an emotional call, I would say. And let's assume even if you don't plan for your kid's education, and if the child becomes a talented child and the child gets into a scholarship or something, then like even that goal can be met with. But the most important thing one should prioritize is retirement. You will miss the bus if you don't plan early. That is the first thing one should consider.
The kids have a bigger runway.
Anji.
They can make money for themselves.
No, I don't say it's a bigger runway, but like for example, there's an alternative. Like scholarships is an alternative for the child. And I know a farmer who has never planned. He was incapable to even plan. But his son runs one of the biggest startup. He got into IIT Bombay, integrated MTech, and he runs one of the biggest startups in India, basically. And so, like even if you doesn't plan for your child, like if the child becomes a talented child, that can be still met with. So, but in retirement there are no such concessions. So you will miss the bus. So that the first, having said that, I'll come to that question. First, a priority should be retirement, in my view. And now to answer about children's, this thing is, most parents do the mistake of not saving adequately when the child is young, and they end up burdening the child by taking an educational loan.
Okay.
basically. And education loan is nothing but a burden to the child. The child finishes his graduation, and by the time the child comes out of the college, like you'll have the child may have a big burden on his head to repay the loans. So the child may be talented and wanting to pursue some masters thereafter. That gets compromised because of the burden. So
But then one way to argue here is, I mean, there are two questions which are coming through. One is, should one plan their finances to actually ensure that the kids, when they grow up, they are covered with their second degree, not just the first degree. But then the counter to this question is, in this VUCA world, as we started the episode, where there is chatter saying that even the basic degrees like engineering or the or whether the colleges will be relevant by that time or no, is going to be a question in the mind. So retirement versus planning for kids education, should you just plan for your retirement and leave the child's education part completely?
no, I believe everything can be accommodated. Again, the two factors are very important. First is like, for example, how healthy you are. If your health is not there, then you may not be able to serve till the end of that goal. So, if you can preserve your health and how competent you are, be it in business or be it in job, like if you are competent and if you are confident that you have a good runway visibility in your profession, so then all your objectives can comfortably be met with. The answer is discipline. So small money, if you invest systematically, then it compounds to a big ocean, and all your objectives can definitely be met with.
Ram, is it better to have the children learn in India itself versus sending them abroad? What is your take on this?
That depends on the child's preference. I have an investor whose daughter wants to do an integrated course of chemistry and economics. The child wanted to have a career in this, but such a course is not there in India.
In India,
And
correct.
so the child had to go out of India and pursue that education. So if the child's preference is that, and if that education is not there, then
Then there's no option but
there
to
is
go
no
abroad.
option. But then, like for example, if you get educated outside India, then you are pushed to take a job outside India. Otherwise, the break even doesn't occur here in India. Like if you get educated outside India and come and work in India,
Correct.
the kind of income that you will get, and you will not be able to recover that cost.
Yeah.
You might require a longer span of time to recover that cost of education.
Yeah.
So the child is pushed to work outside India. So that's the merit and demerit of this. There is nothing like, for example, like the child should not study outside India or study should within India. So, but that the child may end up working there. But then working up outside India is not that easy. Now we are seeing US unfriendly visa policies and all those things.
Yeah.
The child may get an education outside India and come back to India and work. All those things maybe are.
But I feel that it is still difficult to really assess in terms of what kind of corpus is a right corpus to plan for, even without knowing what the child might take up when he or she actually becomes of that age when they want to pursue their masters. For example, an MBA degree abroad could cost somewhere between 15-20 lakhs closer to India in Asia, so to say. Or the premium institutes might be 30-40 lakhs even within India. If somebody wants to take up a course in the US, then the plan has to be for 70 to 80 lakhs as per today's standards. So how do parents really plan for the correct corpus for their kids? Because it seems inevitable for me to me that no matter how much you plan, the child might still have to carry some burden of a loan when he or she decides what to pursue at that age.
Yeah. Like outside education, the parents, when they plan, they will have to withstand two kind of risk. One is the market risk and the currency risk also. So that currency risk is very difficult to visualize. That is a difficult piece here. And if the child doesn't get a scholarship, Now, Harvard, for example, the Harvard Trust themselves, they give fantastic scholarships. So if the child doesn't get a scholarship, then it will drain, like for example, entire lifestyle, drain the finances of the parent. There was some, like some parents, even I had seen channelizing all their retirement savings only to fulfill that overseas education of the child, and they end up living as a dependent on the child's income thereafter. So
Correct.
that is a risk that they take. So it's an emotional call, other I can say. So like so it depends, like yeah, the kind of education, the scholarship. Unless a scholarship is there for overseas education, it will be very difficult.
So then you're saying that it is better off you plan some amount of corpus for your child's abroad education, or
See,
how do you really estimate that corpus?
See, what I estimate is for an Indian masters, good Indian masters, Indian masters will be the costliest in the entire this thing. So then, like for example, some
Indian masters?
Indian masters, and then I assume certain percentage, and then make sure I make them aware that, like for example, there can be during the review meeting, I'll have an idea, like for example, what is the aspiration of the child, where exactly. Then I calculate what is the global cost of the education the child incurs, and how much will have to channelize, like for example, where to increase, where to decrease, out of the objectives. Then I may decrease some amount of this thing, retirement money, and then I may prioritize the masters vagara, and then catch up at a later stage and increase. So some, that's why reviewing their goals is very
Is
very
very
necessary.
important, and also a sound strategy to actually decide where the money is going to compound better.
Yes.
See, but even in all of this, where you're, when somebody is planning for growing wealth for retirement, taking care of children, planning for insurance and everything else, there probably comes a time in life when you end up spending a lot of money, not only for all of these things, but also to maintain a certain lifestyle, buy certain cars, or take care of certain desires that you have. And it could also be a pressure of caring for your dependents sometimes, primary dependents or secondary dependents also. And all of these needs extra money, because the jumps in the salary are probably not keeping up. And that's when typically people get into borrowing and loans. And loan as a product is also of different kinds, no? You have personal loans, you have home loans, and so many other loans based on gold, loans based on some other things, and what have you. What is your take on loans? And when such demands are greater than the money you make, uh, should one still borrow, or should one curtail those desires, or what is a better product in even loans?
Loans, I discourage, like for example, a person to be loan free until the time, like I anticipate in what duration a person is going to serve the loan. I encourage a protection, because if the person passes away, the burden should not be for the family for during for this length of the loan. And then I recommend them to foreclose there. I channelize there, because interest saved is money earned. So I channelize the first and foremost in 5 to 7 years period. I try to, depending on the cash flow visibility, I try to foreclose. I encourage them to be loan free.
Yeah.
And then, like for example, some amount, some amount, I will. It's all tweaking the cash flow,
Yeah.
where to allocate for what goal. And then I also encourage some money towards savings. And then once the loan is over, then they can kind of divert this money towards their savings and other goals that they can have. But loans is costly, and it depends. Like for example, there are some credit card loans are the costliest. PL, personal loans, are the second costliest. But then, like try not to have loans. So plan efficiently, and then you try to, because like today I have a post office in Sadhu Vaswani Chowk. I worked in a godown for 10 years, in a dingy godown, and then, like for example, I saved when COVID-2 was at its peak. I was able to walk into the
A brand new
builder, and
property.
Anji branded builder. I walked in, and then my bargaining power was far superior.
Yeah.
So I was able to buy the office space the way I wanted. So that was an advantage. So I discourage loan
So
in total.
discourage loans as a product entirely, even though it is buying, let us say, a high ticket item like a home or something like that.
See, if the situation demands that if you don't have a choice, then have a loan. Try to fund it through the savings. This is my first my endeavor. And if this is not doable, then getting into a loan is the only option left. Then, what percentage one should have a loan, and in what duration that they can foreclose. This is what I try.
Yeah, but I agree with you when you say that credit card loans are the costliest. In fact, I believe there were recent reports which said that India is um, borrowing like crazy. I mean, earlier in the trend was that the West didn't save; they spent a lot, and Indians were the ones who were having a high savings rate of almost 30-35% of whatever money they make. Uh, but is that is the Western trend catching up with the Indian youth as well?
uh, that trend may be there in the initial this thing, but then we can't equate what happened in US will happen in India in this. And don't go by the absolute number. Like, for example, yes, this number is very high, but we have only scratched the surface in terms of penetration, even in terms of loan. Let's assume even for credit cards we only scratch the surface, and the industry has a long runway
So not
ahead.
many people still have credit cards. Not
Anji,
many.
for hardly 5-6% penetration in India. So, but we have learned. We have enough case studies. What mistake Japan has done, what US has done, and we are very responsible regulators. So, like, if the situation will spiral out of control, two people will be affected. The guy who borrows, his credit scores will be affected, and if he is not able to repay. And the second thing is the guy who has lent, he will improve his underwriting processes, and he will learn from those mistakes, and the regulator will come and clean up the system thereafter. So the regulator is keeping an eye. Today it is not an alarming situation like what that happened, like subprime situation or in US. So it's still in a manageable situation within India. But then, getting into loans deprives a person's compounding the opportunity
Hmm.
for his
Hmm.
other goals.
Hmm. But it seems inevitable to me as we are having this conversation that in the world that we are today, at whatever age group you're in, unless and until the person is actively looking at upgrading his or her own skills and actually finding multiple ways to make money, there won't be enough to retire rich, because there are so many desires and lifestyle costs that everybody is taking care of today.
Okay. I disagree with this statement. If the discipline is a key to this question, so if a person is disciplined and maintains, saves for a longer span of time, with the power of compounding, yes, there is an opportunity to retire rich, because the principal that you invest will be lesser, and the corpus will swell because of the power of compounding. The important medicine here is the time, the period that a person. So it all translates to two situations again: how to preserve your health, and be gainfully employed, be indispensable in your profession for a
Yeah,
longer
as
span of time.
long as possible.
If a person can focus on these two things and give important medicine of time,
Yeah.
yes, there is a bright chance for a person to retire rich.
And it makes a lot of sense. So, like we discussed those two scenarios in the beginning of this episode, that you may be 40 and 45, or on the other side, where you have not saved enough. But if you take care of your health and ensure that you will live long and be gainfully employed, then maybe you're gifting yourself a bigger runway to make wealth and grow richer
Yes.
for the lifetime. There's one more question that comes to my mind is, what are the merits in planning your finances together with your spouse? And the reason I ask this is that we live in a country where, even though women's participation in the workforce is increasing, it's still not enough, so to say, that that the women are the one who are planning finances for the family. But at the same time, what are the merits of planning finances together when both the husband and wife are sitting together and considering as our money instead of my money, and so the I versus we here.
Yeah.
Have you seen some good case studies in these in this case?
COVID second wave taught me a lot of things. My classmates, I have a very good alumni network, and some of my classmates died during the second wave. And the husbands, like for whatever they had saved, the wife was not knowing. And luckily, like for example, I was having a very good rapport with the entire family, and they took my help, and I was able to dig each and every investment of the husbands, and then I was able to consolidate everything and give it back to the wife. So it's always good to involve your family in the conversation. So one, they get aware, they know what they are doing, they know where they are doing, and they know, like for example, what is the target that they are going to. The wife is also aware, and whenever they invest, the family can take a well-informed decision. So there is always there is a significant merit in involving the family member in financial planning.
Financial planning, or maybe it's even inevitable that that's the right way to go. One of the last questions here is, even though we do all this planning and plan for the future, and let's say the wealth is compounding well, how does one ensure that the family does not suffer if one of the, let us say, the breadwinner passes away, suddenly. So I was looking at certain articles online where they said that people are also making something that they are calling their dead box. And the dead box, they have all the passwords and everything else and a complete list of where the investments are and so on and so forth. That is one extreme scenario, but the other scenario is also in terms of planning for passing the legacy to your children. At what stage, these are two separate questions, but at what stage does one start planning for passing on the legacy for their children, or can safeguards be put into place even when you're married and you have your first child? And secondly, how do you ensure, besides all this, that if the breadwinner passes on early, how do you ensure that the family doesn't suffer?
Okay. To answer the first question, everybody assumes when they plan, they assumes a lot of good things, like I'll be getting married, I'll be getting a job, I'll be getting married, I'll be buying a car, I'll be going outside India, I'll have kids, kids will have education. These are the positive things that one plans. But then it is necessary that to introspect on the risk point of view. What if you lose job in between?
Yeah.
Or what if there is a technology risk which makes your entire skill sets redundant? And third thing is, like for example, what if you're not there? What if you lose your health? What if you're hit with some liability case? So I know a client who hit a British pregnant lady in a NIBM hill while riding his bike, and she sued him in an international court. And so it was on a rainy day. So there's a liability risk that literally brought his status of life down. So what kind of, like for example, protection, safety net that they have, if their assumptions don't go as planned, what kind of safety nets that they have? So that kind of a protection they will have to have. That's why it's imperative to have a very good plan, considering the best case scenario and also the worst case scenario, which can pull their status of life down. So, and these protection solutions may not cost much, maybe 1% of their annual outflow. These are crude figures that I'm giving, 2%
Yeah.
possibly. And sound planning is necessary.
And these are towards the insurances and everything that we spoke
Yes.
about already. Okay.
Yes. And the second thing is, once you create an asset, so it's very difficult to give a standard age that, like for when you should make a will. Again, it depends on your habits. It depends on your morbidity, this thing. So I know an endocrinologist in Bangalore, and that endocrinologist is using a sleep apnea. He's suffering from sleep apnea and uses BiPAP machines for his sleep, and because of it, habit risk. Then I said, like for example, you make a will right away. So he was hardly
What is the
37
age?
years,
Okay.
37 years of age. I told him, like, for example, you make a will right away. So we can't give an absolute age, but a person should introspect basis his habits, his lifestyle, his stress levels, and he sooner or later he should make a registered will.
Yeah. So I think the key thing that is coming on in this discussion is that focusing inwards and focusing on health in every terms, so that you're assessing your risks, your health risk, uh, is top priority. But then based on that risk, you can decide when you want to register your will and decide to pass it on to the next generation. I think this has been a lovely discussion, Ram, where we went on a journey from. This was almost like financial planning 101. There's so much advice already available, but you helped the viewers on InnoTalks cover by covering all the buckets, right from starting a career till even passing on the baton. So thank you so much for coming on to InnoTalks. There's one thing that is left. Every guest that comes on InnoTalks, we ask them for a phrase or a couple of words that they can tell our audience, and all those people who have watched this till the end, they can go ahead and comment in our comments box. So what phrase or what line or what two words or one word would you want our viewers to register and then comment down below?
Some plan first and start early.
Plan first and start early. So, plan first and start early is the mantra for today's episode. Because if you plan first and take care of your health, then you have a long runway to hopefully retire rich, achieve all your goals, and do everything that you've always desired for in this beautiful life. By the way, we have also started one more channel which is called the InnoTalks Clips channel, because our episodes are long. We deep dive into concepts, we deep dive into different topics, and we love to hear our guests. But on the Clips channel, you can see 10 or 15-minute clips of these longer episodes, and you can also gain a lot from there. We have included the link below. You can go there and subscribe to that channel also. And don't forget to click on the bell icon. By the way, have you subscribed to InnoTalks on this long form content channel? If you haven't, this is the time to do it. Keep watching InnoTalks.